Hello, everyone, and welcome to our webinar on taxing the digital economy in Africa. I'm Celia Becker, an executive in ENS Africa's Africa Regulatory and Business Intelligence team. As a result of advancements in technology and digitization, businesses can now operate and generate profits in jurisdictions with limited or no physical presence. The African continent is no exception and has also been impacted by electronic commerce, online payment platforms, digital content streaming, and the like. These developments have challenged the global tax environment, as traditional tax rules typically only tax businesses based on the profits they earn in the country where they have a physical presence. I'm joined today by various experts to discuss the tax issues arising from the digital economy across the African continent, and I'm pleased to introduce you to Nadia Hamilton of M&H Consulting in the Ivory Coast, a specialist firm advising on tax in Francophone jurisdictions in West Africa. Welcome, Nadia.
Good morning, everyone. Thank you, Celia.
Then Paul Kwesi Morrison, an executive at ENS Africa's Accra office in Ghana.
Hi, everyone. Thanks, Celia.
George Matia, an executive at ENS Africa's Nairobi office in Kenya.
Good morning, everyone.
Charles de Wet, a VAT specialist from ENS Africa's Cape Town office.
Hi, everybody.
Welcome, Charles. And Scott Salisbury, an international tax and transfer pricing specialist, also from our Cape Town office. Please feel free. Oh, sorry, Scott.
Hi, Celia. Hi, everyone.
Sorry, I'm jumping the gun there. Apologies. Welcome to all of the panelists. We look forward to hearing you discuss this interesting topic. To our audience, please feel free to post any questions that you may have for the panelists in the Q&A box, which we will address at the end of the session, or if time doesn't allow, we'll get back to you afterwards via email or a phone call. Scott, if we can then start with you. The taxing of the digital economy has already been under consideration by international organizations such as the OECD and various other developed countries, for instance, for a while. Could you perhaps give us a bit of an overview of what these global developments have been?
Yes, sure, Celia. So at the moment, international tax rules, by which I mean the rules that are made between countries in terms of their treaties, basically fall into two piles. So we have rules for determining which countries have a right to tax your profits, and assuming that more than one country has such a right, we have rules for deciding how the profits get divided up between them. The first set of rules we call nexus rules. They work on the principle that in order for a country to have the right to tax you, you have to have a sufficiently close connection with the economic life of the country. And these rules are usually based on some form of physical presence. So, for example, where do you hold the meetings where you make the key decisions? Where do you have a fixed place of business from which your employees work? The second set of rules we call profit allocation rules. So, for example, what are the value-creating functions, assets, and risks in your business, and where are they located? And the origins of the system go all the way back to the end of World War I. But for some time, there's been a discussion going on around whether these rules are still fit for purpose. And one of the drivers of this discussion has been the impact of technological developments on the economy. So, according to the OECD, which, as you mentioned, has been looking at these issues since around 2008, there are basically three reasons why a digitalized economy is problematic and breaks the international tax rules. Firstly, you no longer need much in the way of physical presence in a country in order to be significantly involved in its economy. The classic examples of this are obviously things like Google or Amazon Web Services, where you can reach into a country and provide services without having much in the way of boots on the ground. Secondly, as far as assets go, there's a lot less reliance on physical assets and a lot more reliance on intangibles. Intangibles are easy to move around and difficult to assign value to. Thirdly, then there's some features of a digitalized economy which just don't really fit into the framework of the international tax system at all. So, for example, we have things like network effects. Something like Facebook only really has value to the extent that it has users. And the more users you have in a particular country, the more valuable it is for purposes of selling things. But the users don't get remunerated for joining Facebook, and they don't pay to join Facebook. So there's nothing you can tax in the place where the users sit. So you have these really valuable aspects of the digitalized economy, like data and like user participation, which don't necessarily feature in the Nexus rules or the profit allocation rules. So what to do about this? So, as you mentioned, the initial work on understanding the issues has been done by the OECD, initially in terms of the BEPS project, and that was under a mandate from the OECD and G20. But it was clear that if there was going to be fundamental change to the international tax system, the process required buy-in from a much larger group of countries. And so in 2016, we had the establishment of the BEPS inclusive framework, which includes around 70% of the non-OECD G20 countries. And a very extended political process took place and is still taking place to negotiate the changes to adapt the international tax system to the digitalized economy. And in a lot of ways, the inclusive framework became a platform for the developing countries to air what they perceived as imbalances in the international tax system, and these went far beyond digitalization issues. So one theme of the negotiations, for example, has been around whether certain rules should apply only to large digitalized businesses, which was essentially the position of the developed countries, or whether they should apply more generally, which was the position of most developing countries. And in particular, there was a feeling from the developing countries that the profit allocation rules, so basically the transfer pricing rules, didn't allocate sufficient value to the market jurisdictions, and not just in the case of the Facebooks and other platform businesses. So we're now 6 or 7 years down the track in this process, and we're finally heading towards some sort of consensus on how to deal with these issues. And on a very high-level basis, the consensus solution that the parties have ended upon looks like this. So we have proposed new rules which fall into two pillars. Pillar one is essentially in addition to the Nexus and profit allocation rules, and it contemplates two amounts, an amount A and an amount B. Amount A applies to multinationals with global turnover of above 20 billion euros, I think, and earnings before tax exceeding 10%. It's currently estimated that there are only around 100 multinationals in the world which are within scope of this rule, but they do represent a significant chunk of the profits which countries are looking to tax. And where a multinational meets these thresholds, there will then be an allocation of taxable income to these market jurisdictions, provided that certain source rules are met in terms of the value of goods and services consumed in those jurisdictions. The idea is that amount A will be implemented through a multilateral convention. So if you thought all the fun of the MLI was finished, you don't have to worry about that just yet. And then amount B is effectively a simplified set of transfer pricing rules, which apply to baseline in-country marketing and distribution activities. And it currently looks like these will be based on an approximation of the transactional net margin method, with certain predefined ranges being regarded as arm's length. And the intention is that these rules will ultimately become part of the TP guidelines, the OECD TP guidelines. Then you have pillar two, which is a strange set of rules which don't necessarily relate to digitalization as such, but are designed to ensure that the profits of qualifying multinationals are subject to a minimum tax rate. And pillar two is almost more of a BEPS rule than a digitalization rule as such. And the intention is that it will be implemented through domestic legislation. Given that it's taken 6 or 7 years to get to this point, some countries have understandably decided that they need to implement unilateral measures to protect their tax bases. So we've seen widespread adoption of digital services taxes and similar, both in developed countries and developing countries, including some African countries. And part of the difficulty in implementing the pillar two, the two-pillar solution, has been that in order to sign up, countries are required to roll back their digital services taxes, which they've been reluctant to do until there's something concrete in place. And essentially, that is the state of play in taxing the digitalized economy. It's a negotiated solution. It involves a lot of compromises. It has, in a lot of ways, gone quite far off the tracks with regard to its initial goals, which were very focused on digitalization. And there is also a lot of work to do on these rules, but we are at a point where there's some form of broad consensus on how things are going to look going forward.
Thanks, Scott. Yeah, clearly very complex, and I think there's no easy solution, one size fits all. George, if I can turn to you, Africa has seen some significant growth in the size of its digital economy in the recent past, which tax authorities on the continent obviously want to tax. What are the trends that you've seen in the continent, and have African countries been implementing some of these guidelines by the OECD, or what have you seen?
Yeah, thanks a lot, Celia. So Celia, the general trend is that most governments are viewing digital services as a new way of generating revenue, for themselves. This coming on the back of the COVID pandemic, where tax revenues fell, whilst government spending increased. Governments are now forced to look for new ways of generating tax revenues. Traditionally, it has been difficult for governments to increase income tax revenues, and they've largely focused on indirect taxes such as VAT and excess duty, which are consumption taxes. But DST now brings in new sector which didn't exist 20, 30 years ago. Okay, so governments are seeing it as a very new way of generating revenues. Now, the DST regimes are unilateral, as explained by Scott. And what most governments feel is, this Pillar 1, Pillar 2 OECD global deal is a bit too complex to implement within Africa, especially given that the tax authorities are already struggling with, low administrative capacity. So what then they've done is, as an interim measure before the global deal gets concluded, have this unilateral tax DST. And we've seen, several countries come up with them. Kenya, Uganda, Tanzania, Nigeria also has DST rules, and we'll get into that in terms of the detailed in-country trends. Over and above that, the general feeling that we are seeing is most African countries feel they would be more comfortable with a UN deal as opposed to the OECD-driven deal, because they feel they may have, a better say, in terms of driving their own economic agendas. There connected to DST is money remittance taxes. There are governments in Africa who feel that telecoms are not adequately taxed, even if they do feel that they're adequately taxed. And we are starting to see some countries come up with, taxes on money transfer services. Ghana introduced a 1% e-levy. Nigeria has a 50 naira electronic money transfer levy. Cameroon also has one. Kenya has excess duty of 12% on fees charged by mobile money transfer entities, and so on and so forth. The downside is that these mobile money transfer fees have impacted transactions, and we are starting to see a bit of rollback on that. For instance, in Tanzania, the electronic services levy on money remittance was scrapped. Malawi considered introducing money transfer tax in 2019, but then they backtracked on that. In Ghana, the 1.5% money transfer levy was reduced to 1%. So at the end of the day, the trend is the government is looking at this as a new way of generating revenues, but there are pros and cons in terms of their ability to collect taxes from this.
Mm-hmm.
Yeah.
Thanks, George. I understand that the African Tax Administration Forum has also issued some guidelines on digital taxation, specifically digital services taxes that you've been talking about. Can you enlighten us a bit about what they propose in the guidelines?
Yeah, so sometimes in around October 2020, the Africa Tax Administration Forum, ATAF, produced a paper which was referred to as suggested approach to drafting legislation on digital services tax, right? And the whole essence of this paper was to provide African countries with a structure and a framework for introducing DST, taking into account the specific considerations and challenges for each African country. So what they noted was that, here is a very quickly growing sector, and African countries are struggling in terms of how to tax it, right? And so hence why they came up with this suggested approach. So under the suggested approach, their main goal was to try and ensure that the DST that is introduced by different countries doesn't have the effect of stifling the digital economy, which is still quite young. So the proposal by the ATAF was to have DST at a rate of between 1% to 3%, and to also take into account whether an entity is loss-making and if an entity has low margins. So to have a robust de minimis threshold such that it then thereafter doesn't kill the small entities which would be affected by DST. And then the proposal also included a formula for determining, what profits would be attributed to a country, and how the filings would be done. And the proposal was that one of the entities in a group, referred to as a responsible member, would be required to do the filings on behalf of the group. And if there isn't, an entity that is resident, or if there isn't a permanent establishment in country, then the appointment of a local representative was also proposed. Now, whether or not countries have adhered to this 1% to 3% is a different question, because the DST rates we've seen in some countries exceed the 3%. Yeah? For instance, the Uganda proposal, which was recently effected, is 5%. So Nigeria operates on a 6% DST rate. So there is a question as to how this has been implemented per country. But we are likely to see more. We are like, in general, these countries have, in terms of the process and the filing requirements, they've sort of taken into account ATAF's proposal. Yeah.
Perfect. Thanks, George. Very interesting. Charles, if we move to your field of specialization, VAT. VAT is obviously a key instrument used by many tax authorities to tax digital services, and I think Africa is no exception. So the first question probably is, but what would generally be regarded as a digital service that would be subject to VAT on digital services? What have you seen in that regard?
Celia, the issue around digital services is that there is no one single definition that applies across the board, and this makes it very difficult for companies that are making their services available in different jurisdictions, because they have to contend with a raft of different rules as far as that's concerned. The OECD starts off at a very high level and talks about services and services and IP that is applied in a digital format. They kind of give a list of applications and in-app purchases. They talk about streaming of music and on-demand television, gambling, ride-hailing, accommodation rental. So that could pretty much include everything. Ghana, in its definitions, has gone a bit further than that. They also talk about social networking. Gambling is already there. Cloud services, video and audio streaming, which I think I already mentioned, and then online advertising. Whereas South Africa just talks about any service that is supplied via the internet. I think that what we're seeing substantially is that as supply chains become more sophisticated, they are becoming more digitized and potentially get into this definition. But what's interesting about it, it doesn't only limit it to services, because there's also a big challenge globally in terms of sort of digital marketplaces or platforms as far as that's concerned, where it's possible to buy low value goods that often come in below thresholds. So when you buy from a foreign supplier and it comes, and there is physical movement of goods, but because it's below a certain threshold, it may not attract customs or VAT when it clears the border. That's also sort of being shoehorned into this space as well. So this will be an ongoing challenge as we try to get to grips with the broad ambit of services that are electronic services or ESS.
Thanks, Charles. You've made reference to the OECD's definition of digital services. I understand that they've issued some specific guidelines for VAT purposes on how to treat digital services. Can you tell us a bit more about that?
So earlier this year, the OECD issued the VAT digital toolkit for Africa. I mean, there was a lot of work done at the OECD, in terms of the digital space and on-demand services, pretty much. And I mean, this is now a subset of that, as in respect of one of the important regions of the world. What is significant about it is that it's pretty much a guideline for African tax authorities in terms of how they should design a digital tax with the least disruption to the economy as possible. I mean, it's 401 pages. So if you've got lots of time and you want to work through lots of examples and lots of checklists, then it's good reading from that perspective. I mean, it was a collaborative effort, between ATAF that we've already referred to, and also the World Bank Tax Group, and there's a very comprehensive publication from that perspective, and gives really good guidance. In terms of sort of the approach in this particular place. What it does do, it very emphatically confirms the destination principle for VAT purposes, which means that you should be taxed where the consumption really happens in the circumstances. So very much based on if you're in a particular country, then it should be taxed there, and obviously that has a very big impact on the tax revenue for various African countries. I mean, there's a big challenge on revenue collection across the globe at the moment. And, if there's suddenly, in respect of low value goods or services that are now being supplied from offshore, it is important that that gets into the tax net on some other basis or as well. I mean, in terms of sort of the high level approach that they followed, it's sort of made up of 4 pillars as far as that's concerned from a guidance perspective. And does a comparison between, some African countries that have already got the rules, other countries, or the approach followed by other countries around the world. But it starts off by looking at the legal framework, and talks about, that the location of the service is important, and that is pretty much linked to where the recipient is located. So it should be, taxed where the person actually lives or receives that service. And there are a number of proxies that are used in those particular circumstances to do that: bank accounts, addresses, residency rules, etc. It also deals quite a lot with the so-called B2B and B2C distinction. Business to business transactions and business to consumer transactions. In many instances, and particularly in Europe, VAT is much more focused on B2C transactions, with B2B transactions not being subject to these cross-border taxes. And the reason for dealing with this at this level of detail is that very few African countries do in fact have that distinction in the legislation. So if you look at it from a South African perspective, from most of the countries that do have a VAT system in place, is they look at the nature of the supply and not at the customer at all. So it makes no difference whether it's a business customer or a consumer that is acquiring those goods or services. The tax treatment is identical in the circumstances. Now, I think it's important that when you introduce an ESS tax or digital tax, in the VAT space, that it mirrors the domestic legislation. Otherwise, it does just create confusion. Although I must admit, in terms of foreign companies that often we create significant confusion simply because people are not used to dealing with no distinction between B2B and B2C, and assume that because they're selling it to a distributor, to a platform in South Africa, that or in Tanzania or in Ghana, that on that basis they don't have any obligation to register in those particular jurisdictions. So that was the first pillar that it was based on in terms of the enabling legislation, that you get to achieve this in the best way of doing that. The second aspect was, sort of around the efficient collection of that and mechanisms that you can use to make sure that the revenue is collected in the circumstances, and that's pretty much focused on an efficient registration process, so that it's not difficult for people to come and register. That you don't have to create a permanent establishment, you don't have to create an in-country legal entity or register a branch in the circumstances, or in fact, often in many cases, not even have a local bank account, but can simply register from offshore, have your tax representative sitting offshore, and that it's really easy for them to, for foreign businesses to in fact get into the net on that particular basis. The third pillar is very much around the collection mechanism and what the most efficient way to achieve that collection is, and whether it's the use of platforms or how it gets into the country. So that could be using the kind of the telecom networks, if they're distributing into other platforms that come in where the data flows through, that you could pick it up on that particular basis. Because on the one hand, the recovery of these taxes from foreign companies established in foreign jurisdictions is often complicated to do. So you need to have some sort of way to achieve the cash flow that you need in the circumstances by making it as easy as possible. I think what we are seeing in that space is that exchange control regulations are often problematic, and banks are from a timing perspective, and getting money paid in time is often a problem as far as that's concerned. And then the fourth pillar that they recommended was very much around a modern risk-based approach. How do you, in inverted commas, encourage foreign entities to come and register in your particular country? How do you encourage compliance? So that once you've got somebody into the internet, you do in fact have the information to be able to collect the taxes and to get the returns in that are required on a regular basis. And very much all of this is around the ease of administration. So being able to do it online, to be able to make payment online as well, and then to gently nudge people, to make them aware of the fact that it is necessary to come and register. I think that what we're seeing in that space is that the revenue authorities are approaching sort of local suppliers and asking who their foreign suppliers are as supply chains become more digitized. They're also very aware of advertising that's happening in country, and it would not be surprising to get a letter from a tax authority to say, are you registered? Should you be registered? Shouldn't you think about registering in our particular jurisdiction? And very much what the AUCD is proposing in this substantive report is, if there's a little bit of consistency, obviously with the distinctions between local legislation is applicable, but if there is a process that people follow, on the one hand, to get the provisions implemented, and then to make compliance and payment easy in the circumstances, you've got a much better chance of success. That's kind of setting the framework as far as that's concerned. And there's no doubt that with ATAF's involvement, we can expect to see more and more countries that are going down that route. A number of them have already, but we're going to be see that happening more and more in future.
Thanks, Charles. Yeah, I think, as you say, over the last 6 months or so, I've seen quite a few African countries that are requiring foreign digital service providers to register for tax, for VAT purposes. and it creates all sorts of its own practical problems there. But we'll chat to each of the guys in country to see how the authorities have been dealing it. Thank you, Charles. Nadia, you've mentioned in some of our previous conversations that you've been seeing significant developments in digital tax compliance and enforcement by tax authorities in West Africa, which is a bit of a different slant on the digital taxing of the digital economy. But can you tell us a bit more about your experience and what you have been seeing in the different jurisdictions that you deal with?
Yes, thank you, Celia. I would say that what we've seen is the tax authorities in various countries are trying to accommodate with the digital economy that is coming as well in our countries. But obviously it was very paperwork based, and they felt that they needed to first upgrade their system internally, the administration, before they can move on to actually try to track the digital economy and the transaction going through. So I believe that many of them have started through the compliance, and that's why I think the subject is relevant. Because before that, everything was done on paper, including payments as well. And we've seen for about 2 to 3 years that they are now putting everything in online. We can have tax compliance being done through specific website, the tax authorities website, where the taxpayers can come and prepare their tax returns, the financial statements. They can receive certificates because before that you needed to go to the tax authorities physically. They can check their tax file, and they can also make the payment online. So the payments are now going through bank transfers or online mobile payments only, which is also a big change, and it does create some issues, obviously, coming with that. You also have the tax audits that are being done now for some of them online, where you can receive a correspondence from the tax authority and provide documentation directly through the online system of the tax authority, and receive the response through there, and obviously carrying through the payment as well, which is a big change. And it has happened in Ivory Coast, in Senegal, in Gabon as well, where you do the tax returns online, in Togo and Benin, that are really fast-tracking their digital processes, in Burkina Faso and in Cameroon as well. So it's really going throughout many of the West Francophone countries.
And I think you mentioned also that in some cases the revenue authorities would even use information supplied by, say, suppliers to check the records or the tax compliance by their customers, and the other way around. So there's also quite a big development.
Yeah, definitely. And this is actually trying to get there to the digital economy, because we'll see probably later, and we also discussed that already, that VAT is one of the taxes that are being applied to the digital economy. And to actually follow that up, they need to set up their VAT processes. And it's still difficult, and it is still a difficult process, because obviously they have to carry through all the transaction going through invoices. So now they are digitalizing invoices so that they can track the tax numbers for suppliers and also clients. They are digitalizing as well the VAT process through the tax return, so that they can really cross-match any payment that has been done through another supplier, and it actually through the system accept or reject any tax deduction. So it is a very big change, because you can see it actually automatically flies up all the taxpayers that do not have a proper tax number or weren't on track with tax compliance. So obviously it goes with all the difficult technical
I
glitch that
can
goes
imagine.
with that, bugs and all the mixed match information and incomplete information. And obviously, since they are basing their VAT tax audit on this information, it creates a lot of arguments to try and reduce down the number of invoices being applied to your company where you never had the supplier, for example, and try to clear the information first before you can actually deep through your tax audit. So yeah, it creates a lot of stress for taxpayers and companies in this instance.
Yeah, I can imagine it is quite a powerful tool that authorities are starting to use.
Definitely.
Thanks, Nadia. I think if we turn a bit more to kind of regional and country-specific developments, Paul Kwesi, if we can start with you. I understand that Ghana has been using VAT as one of its key mechanisms for taxing digital service providers. Can you tell us a bit more about how this has been implemented and which digital service providers are subject to VAT in Ghana?
Sure, Celia, thank you. Yes, in Ghana, non-resident persons who provide digital services are required to register for VAT once the persons provide those services for use or enjoyment in Ghana. Maybe if I would go into some bit of detail, as Charles mentioned some of the examples. So in Ghana, if you are developing or creating or customizing websites, that's considered as digital services. Website hosting, subscriptions, including for journals and newspapers, are also considered digital services. If you used search engines or internet directories, it's also considered digital services. So there are a number of these that you would have some detail around, which clearly then specifies that these are digital services. There are, however, things to consider if you were to be seen as having supplied digital services in Ghana. And there are 4 conditions, two of which, if satisfied, would then mean that a non-resident person has supplied services in Ghana. One is that the recipient of the service must be resident in Ghana. 2 is that the recipient of the service should have an address, whether it is a business address, whether it's residential address, or even an internet proxy address or a telephone number in Ghana. 3, the service must be received on a terminal in Ghana. And 4, the payment of the supply of the service must originate from a payment platform or financial institution in Ghana. Once we have 2 out of these conditions established, then the non-resident person would have supplied digital services in Ghana and would therefore be required to register. Indeed, the requirement for registration, and as I hear my colleague Nadia mention, has also been around. In fact, in Ghana, it had been in our laws since January 2014, except that it had not been implemented because the Revenue Authority did not have systems in place to enable, if you like, registration until March 2022, when they established an online portal system for registration. And therefore, the requirement to register took effect from 1st April 2022. And therefore, as I mentioned previously, once you are a non-resident entity and you supply digital services in Ghana, then you are required to register for VAT, file your returns, and pay VAT, but through the online system, unless maybe you have supplied through a VAT registered agent in Ghana. And maybe just to also confirm, as Charles mentioned, that in Ghana, the requirement to charge VAT applies to business and business to consumer supplies.
Thanks, Bokwezi. In addition to VAT, I think George alluded to it, but in addition to VAT, are there any other taxes that the Ghana Revenue Authority is levying on digital services? Digital service tax or withholding tax? What else have you seen in addition to VAT?
No, so there are no additional taxes that, if you like, levied by the revenue authorities on the provision of digital services. Once you are registered, you are required to ensure that you file your returns at the month that follows the month in which the particular service was provided. And you need to also then calculate the VAT correctly. Maybe what I need to also note is that the VAT itself is calculated on all taxes or duties that may apply to the particular service before the VAT is applied. And therefore, in Ghana, we have what we call a National Health Insurance Levy, a GET Fund levy, and a COVID-19 levy. Because all of these duties are supposed to be applied to the service before the application of the VAT rate, you would need to ensure that if, for example, you supplied a product at 100 Ghana cedis, then you would apply the various rates onto the 100 Ghana cedis to come to a total base value. And it is upon the total base value that you would need to apply the VAT to. So that probably is, if you like, additional taxes, but that would not be taxes that are payable by the non-resident entity. It is part of the charges that is to be transferred to the person who is receiving the service. I think on some of those questions, the point maybe to note is that once a person registers for VAT, it does not trigger the creation of a PE. Charles alluded to that, and yes, in Ghana, it does not require you to, you would not have created a permanent establishment, and therefore the consequences of a PE does not arise. There are also no, if you like, corporate tax requirements, and I think that also links into the PE, except that if you made revenues in Ghana as a non-resident entity, then there would be withholding taxes. One point to also note is that the VAT that's paid is non-deductible for input tax on the non-resident. There is also a withholding VAT regime that we have in Ghana, where persons who charge VAT are supposed to, persons who pay VAT charge on them are supposed to withhold a 7% portion of that and pay over to the tax authorities. And therefore, if a non-resident charged the VAT, the resident consumer will need to withhold on 7% of the VAT, except that when the non-resident entity is then filing returns, then this is taken into account in filing that return, Celia.
Thanks, Bokwezi. I appreciate that. And I think you also have an e-levy in Ghana, don't you?
Celia, say again, please.
Yes, and don't you also have an electronic levy that's applied in certain transactions in Ghana?
Yes, there is an electronic levy that's levied on certain transactions that take place in Ghana. If you are making money transfers, then yes, you would have an e-levy, whether you make it through the bank application or you make it through the mobile application. There would be e-levy that's charged for those kinds of services. So yes, we do also have the e-levies. George mentioned And yes, that's correct. For applications that you make through the bank, there is a limit of 20,000 Ghana cedis. That's probably about $2,000 equivalent. That for which you would not have to pay a e-leon if you transacted through through a mobile application.
Thanks, Bokwezi. Very interesting. Nadia, you've obviously spoken about the digital compliance initiatives in Francophone countries in West Africa, but just in general, kind of what types of taxes do you see authorities levying on digital services? Is there kind of a focus towards VAT or digital services tax or withholding tax? What have you seen?
Okay, thank you, Celia. Yeah, in several Francophone countries, there is two types of digital businesses that are thriving, I may say, and these are the ones where the tax authority focus their rules on. The first one is the online payment platform, mobile payment platform that is very developed in several West Francophone countries, even competing hardly with banks. It's the main way of payments for people who can't afford to have a bank account. And the second type of service is based on digital platform like transportation services or goods and food deliveries, etc. So all the rules have been set up around these two blocks of digital services. For the platform, the online platform, it is required for the online payment, sorry, it is required to set up an entity in the country because until now, you do need a banking license to actually provide those services because you are dealing with electronic money. And therefore, the tax treatment will be the same as the normal tax compliance and tax levies that you could have for a basic company in the country. It will be corporation tax, you will have some withholding tax, but there is also for specific transaction, specific levies, as was mentioned by Bokwezi earlier, e-levy that is based on the commission you pay when you use the online payment platforms. It doesn't go through banks. It is retrieved directly from the service provider, and it's part of the tax that they have themselves to pay to the tax authority. There is also specific percentage of tax, corporation tax for telecommunication companies, and I would say assimilated type of entities. But they are big ones, and therefore these are the ones where they have more taxes, because that was the beginning of touching the digital economy from our countries. For the service provision through digital platforms, these are the services where companies are generally abroad. They don't necessarily need to set up entities in West African countries. This is where the governments are still thinking of more strict rules to actually evaluate and assess the flow of transaction going through this digital economy, because right now they know that not all of it can be actually sustained and paid for. But for these specific service provision companies, they have compulsory VAT to actually register for. And some countries such as Ivory Coast or Senegal, Benin as well is putting that in place, and Gabon shyly, but they are getting there. They provided an easy, I will say a fast track way of creating a tax number for these foreign companies so that they can pay the VAT associated with their local transaction. In the same way, the VAT is applied where the beneficiary is based, and it applies on the commission that are received by those companies. And it's either through the exploitant of the platform, if he's based in those countries, or the seller of any goods or services or the buyer, so that will be the end customer, or the user of the service. If all of these categories are based in the given country, then the local VAT will apply on the transaction, and these digital companies must actually calculate the VAT in the normal way and pay through online payments through their portal, their local VAT. They have sanctioned, specifically in Ivory Coast, for companies who don't follow these rules. They have the ability to block the platform so that it can't function to actually allow customers to get through there and provide the goods and services involved. It hasn't been implemented yet, but it's in the rules, it's in the law, and it can be used as and when they need to. But generally, it is more focused on VAT and based specifically on the platform providers. I have to say that for about 2 years now that they put that in place, and some countries are developing that or implementing that and assessing it better than others. The tax authority have difficulties actually to collect their money, and the creation of VAT numbers is not actually functioning well. I believe it must be part of the training that the local tax authority staff do not necessarily have, but due to the bugs as well that we experience in several countries, they find it difficult to get through the actual setup of the VAT number. So they revert back to paperwork ways of actually collecting VAT, and he finally puts all these companies to set up entities finally to be able to function and operate in the given country. So I have to say that for what I could see for clients and other companies that we see operate in those 4 specific countries, they had set up a form of entity to actually get through the VAT and all the other taxes, because withholding tax is also implemented through the consumer company, not individual, that we actually get the tax, the receiving goods or service, but it's not functioning as well. So they have to set up an entity to actually get through all this tax compliance. So it is difficult, but they are getting there.
Thank you, Nadia. I appreciate that. George, I think you've alluded to some of the developments across the continent, and particularly in East Africa, but are there any specific taxes or examples that you just want to highlight, or latest developments in Kenya and the rest of your region?
Yeah, thanks, Celia. So within the East Africa region, countries have adopted digital services tax from 2020 to today. So Kenya has had DST since 2020 at 1.5%. There was a proposal to increase this to 3%, but that was dropped given public outcry. Uganda has recently introduced DST at 5%. However, there are some challenges around how that will be collected and implemented. Tanzania has DST rules at 2%, at the rate of 2%. And all the 3 countries do impose VAT on DSTs. Now, the main challenge with implementing DSTs really has been around how it works, given that it applies on gross payment and not really on the profit. So it impacts on entities where if their profit margins are quite low or if they're loss making. Yeah. There's also a bit of an issue around characterizing whether a service qualifies as a digital service or if it should fall within other areas of other services which are taxed separately. For instance, would it be a royalty or would it be a commission, which would attract separate and different rates of withholding taxes? So there's been a bit of issue around that, and there's been quite some tax disputes between taxpayers and revenue authorities around that. Yeah.
Thanks, George. And I think last but not least, Scott, Can you give us a bit of an overview of what has been happening in South Africa and maybe in Southern Africa?
Yeah, thanks, Celia. I think the Southern African countries are largely playing a wait and see game. So Botswana, Namibia, South Africa, Zambia, all signed up to the outcome statement on the 2-pillar solution. Zimbabwe hasn't signed yet, to the best of my knowledge. South Africa and Zambia have been directly involved in the inclusive framework discussions. The other countries have been, have felt that they've got limited capacity to actually administer their own internal revenue and also participate in these discussions. So their involvement has largely been through ATAF, and they've indicated that they're generally aligned with whatever comes out of the process. So yeah, we watch the space with interest. I mean, what is interesting is that the 2-pillar proposal isn't a wholesale replacement of what we have now. So we're going to be dealing with an overlay of the new rules on top of transfer pricing rules and existing treaty rules. And ultimately, I think it's going to be just as important as ever to understand the scope of intangibles that you use in your business and how they're developed and exploited, map out the legal and economic nature of your transactions in order that they don't get second-guessed by the tax authorities. But yeah, interesting times.
Yeah, and I should say, I think from what everyone has been saying, and especially Nadia's comments on using the digital kind of economy effectively to enforce and collect taxes, I think that will just put more pressure on taxpayers to be more tax compliant and making sure that they have the ducks in a row.
Yes.
But yeah, I think that brings us to the end of our session. Thank you so much to each of the panelists for your valuable contribution. And to our audience, thank you so much for joining. If you have any questions or follow-up inquiries based on our discussion, feel free to contact any one of the presenters or whoever your contact is at ENS Africa or MNH is. But yeah, thank you so much and enjoy the rest of your afternoon.
Thank you. Bye-bye.
Thanks, everyone.
Thanks, everyone.
Thanks.